Hi guys, this is Nora Redko and welcome back to another episode of TRITON. On today's episode, we're going to be talking about market commentary and we're going to reveal some potential warning signs of a market correction. The first warning sign is a discrepancy of return between the S&P 500 and the SPLV. The SPLV is the top 100 least volatile S&P stocks index. Historically, when the S&P outperforms the SPLV extensively, there tends to be a market correction. As seen in the graph, during January and March of 2018, the S&P always converged back to the return of the SPLV. The second warning sign is a potential drop in intermediate government bond yields. The S&P 500 has a 2 standard deviation positive correlation with intermediate bond yields. Thus, as investors fear a U.S. economic growth slowdown and 10-year yields lower, it can be expected that the S&P 500 will lower as well. Nevertheless, there is one macroeconomic factor that may keep the S&P 500 afloat, and that is corporate cash flows. As earnings announcements begin to pick up this week, companies will have the opportunity to justify their valuations with bottom-line earnings growth. If the earnings can justify the already priced-in U.S. economic growth, the S&P 500 may still stay afloat. In conclusion, as referred to in our stocks tips video, know when to take your profits. Thank you so much for watching. Please like, share, and subscribe, and don't forget, hit that subscribe button.